Good afternoon, everyone. It's a distinct honor and pleasure to be part of the Digital Asset Forum this time around as well. My name is Federico Mele-Cormier. I am the CEO and co-founder of GenieAI, a Boston-based AI-powered portfolio and risk management system. I'm delighted to have here Felix Stratmann from Outerlands Capital and Tara McCauley from Pharos Fund. So welcome, and would love to get an introduction from, let's start with Tara and then Felix.
So I'm Tara McCauley. I've been trading Bitcoin for over a decade now. I was the co-founder of Alameda Research, then left in 2018 to set up Pharos Fund, and we do market-neutral trading across mostly centralized exchanges, but about 400 different digital assets. We also have one fund with directional component and a Bitcoin-denominated fund, so cover a lot of things all in the liquid token space.
Cool. Hey everyone, I'm Felix Stratmann. I'm a head of research at Outerlands Capital. We are a liquid token hedge fund. We have I would call it a quantamental strategy. The base is a sort of a systematic factor-based model, ingesting a lot of data, coming up with trade signals from there, but also overlaid with a discretionary, more bottoms-up type fundamental overlay that kind of tries to capture some of the more difficult to quantify risks and opportunities in the space. And yeah, we invest across a broad range of tokens, call it the top 150 or so, to end up with a fairly diversified portfolio of 30 to 50 tokens, depending on the time. And yeah, I head up the research on our strategies and also the research you'll find on our website and other publications.
Fantastic. Thank you very much for the introductions. So I'm curious to hear a little bit more about what is the process that goes into creating alpha in digital assets, and you two represent two very distinct segments of the investing world in digital assets, more a fundamental or quantamental side on Felix and Outerlands Capital side, and a more systematic algorithmic approach on Tara's side. So talk us through the approach, the framework, perhaps some of the data that is leveraged, and then if you can comment on the skills that are required to do that type of job and extract alpha.
So I think digital assets are this amazing source of alpha opportunities because it's incredibly volatile, there's fragmented liquidity, and so there's huge opportunities for mispricing. So we try to look for areas where we expect that there are barriers to entry and there are reasons that you would expect to see mispricing, and that is something that we could capture. So we screen any token on the exchanges that we trade where there's at least 2 derivative contracts with at least 10 million in average daily volume, because that's where we can get off enough size. And then within that, we'll try to think about why we're seeing market mispricing and make sure we understand that so we can capture it and expect that spread to close. So for us, that means pulling in pricing data for all the assets we trade across as many exchanges as we can connect to, but it also means we have to look at other data sources as well, because information asymmetry is another reason why you see mispricing. So we have to monitor what's happening in the code base of various projects and look on Discord and see if there's news that is being released there that hasn't been priced in by the rest of the market first. And so we always need to think about what fraction of the market has integrated this information and what is still yet to come so that we can capture that trade.
Yeah, no, I think those are great points. And just real quick, to keep my compliance people happy in the US, all views are my own and do not constitute investment, legal, tax, otherwise advice, not financial advice, do your own research. But yeah, the core to me of investing in crypto, right, is data. I come from a TradFi background, and it was always about ingesting the data that you have access to and finding an edge in data that not everybody has access to, leveraging that in creating investment strategies that are process-driven and repeatable. So I think in crypto it's a real challenge because the data landscape is so fragmented. We're ingesting data from all parts of the market, price data, market data, trades, et cetera, but also fundamental data. And, it's a matter of having breadth of data. We want data on as many projects as we consider investable so that we're actually comparing across the spectrum. We want depth of those projects. We don't want to just be looking at fees, users. We want to be looking at relevant metrics. Yeah, and then I think you need to spend a lot of time just leveraging your own intuition with this data. I think there's nothing in the crypto space that can be taken at face value that you can just download from an API or a CSV, and just trust. I think you have to review everything and ensure there's comparability. And I think once you do that and leverage that into your investment framework, there's a lot of alpha to be out there.
And speaking about alpha, one topic that comes to mind as I speak to digital asset managers and allocators is what time frame makes sense as you apply your own investment frameworks to extract alpha. And Tara, for example, those mispricings that you identify, what time frames are you looking at, and what cyclicality in the market do you keep in mind as you implement your trading strategies?
For us, we look for trades that we expect to revert within a matter of minutes through to weeks. So sometimes there's a structural reason that we see a pricing discrepancy that might continue for some period of time until that closes. For example, if there's like a lot of long demand on a token, you might see funding rates persist for weeks. And so until you expect that to flip, you can capture that trade. On the pure sort of arbitrage side of things, like great times for us are times like overnight last night when we saw close to $10 billion worth of liquidations. And because we've seen leverage move back into exchange rather than in 2022, a lot of the leverage was concentrated OTC, and with larger settlement times, that was a much more violent cascade of liquidations that created pricing discrepancies that would revert within a minute or so. So we'll look across that whole spectrum, but it's mostly about trying to figure out why does this exist and how long will it take for the spread to come in. And it's really important to get the timing right so that you manage the risk effectively, and also so that you can allocate the portfolio to get the best return on capital on a time-weighted basis.
Yeah, I think from my perspective, a little bit of a longer time frame generally for what I'm researching. I think we try to hold positions for at least a quarter or so, and that's because although we leverage signals that we get from a quantitative model, we do ultimately invest in positions that we believe hold fundamental long-term value. And I think that when you're directional in that way, you want to give those trades time to play out. So yeah, we're looking at generally a minimum holding period of about a quarter. We frequently rebalance and reassess. There are a lot of things that can move the market, within a year or shorter time frames than maybe the longer time frame that a VC might have or something. So we'll adjust accordingly if there are catalysts, both positive and negative, to change positioning. I think all these need to be accounted for, even if you do have a long bias strategy.
And Felix, in a world of meme coin trading where a lot of discretionary funds do a lot of activities trying to take advantage of these short time frames and meme coins and altcoins without substantial fundamental value, at least at a face value, how do you position your position sizings, your portfolio selection, your screening of assets? What type of data do you look for within a project to make your selection up top?
Yeah, absolutely. And, I think meme coins are their own thing. It's not an asset, sub-asset class, I guess, that we necessarily focus on. But I think we are looking for projects ultimately that, there's a product that satisfies demand, that there's an addressable market, that market has a certain amount of scale, and that business has a long-term road to profitability. I think there are interesting projects in the crypto space, that maybe ones that are more aligned with the completely decentralized, disintermediated nature of, I guess, crypto philosophy, but maybe those tokens don't make for great, investments. There can be great companies that aren't good investments, and, good investments and not great companies. But ultimately, we're looking for what you might look for in the TradFi sense, fee generation, usage, a structure that is conducive to bringing value to the token, those sorts of things. And yeah, it's a matter of ingesting data on the common metrics like fees, transactions, users, et cetera, but also for each project, it's going to be different. You have to really assess what the KPIs are and evaluate the project based on that.
I would say, though, there is a really high correlation between all of the different assets with each other. So, almost everything is at least 80% correlated with the price of Bitcoin. And one thing that's really important is to make sure that you're generating real alpha rather than just beta. So we always look at how well our trades are performing compared to, say, Bitcoin basis or funding rate. And then the next thing that we need to worry about a lot is, are we just getting paid for the additional risk that we're taking? So we try to focus on generating risk-adjusted returns, and then you need to think about what's the risk of that venue collapsing, or there being an issue in the contract, or a protocol that's quite new. You can generally find fantastic opportunities in things that are new, that are growing, and where there are barriers to entry, but you might also expect that there's higher risk there. So how do you compare those two strategies?
And Tara, so the industry is relatively young, and a lot of the inefficiencies that systematic funds take advantage of are due to the inefficiency of the liquidity across venues and counterparties. How do you think that will evolve over time, and do we need to fear any alpha decay in these type of systematic algorithmic strategies? What mitigations are you looking to take?
So when I started the fund, we expected that there would be a much higher degree of alpha decay than we've experienced so far. I think what we've actually seen happen is that the growth in the industry has outpaced how much the market makers and traders have been able to scale. And then the cyclical nature has also meant that there's variable levels of capital deployed to market making and arbitrage-like strategies in the space. So we've sort of seen an evolution where when we started in 2018, we were just doing very simple cross-exchange arb. And then in 2022, right before the Luna situation, that was probably the time when we saw those opportunities get compressed the most. But as of last night, the last couple of months, again, we've seen growth in the space, and we're seeing those simple arbitrage opportunities pop up again. So I think you need to have a constant R&D program to make sure that you are keeping abreast of what's new, developing new strategies, but don't throw them away because these things keep popping back up.
And what do you think, and this is a question for both, investors and traders should not look for alpha? What are some dangerous pitfalls that perhaps investment managers fall into, and what should we be aware of?
Yeah, it's a good question, and I think one thing that I've kind of been thinking about today, even, is just I think you hear a lot of people talking about how the crypto space is purely narrative driven. You have to understand the narrative, and that's all there is to it. But I think that's a fact of the market because it is primarily retail driven now. And the other big thing everybody talks about is the institutions coming, and institutions aren't going to behave like retail investors. So I think that when you're creating a trading strategy, an investment strategy, you want to be focused on how the market is going to evolve, not exactly how it's been. How it's been, coincidentally, has not been around for very long. You're working off of 5 to 10 years of good data. So I think you can't just take what has happened in a market that's been driven by retail and expect that once it matures and institutions get involved that it's going to behave the same. So I think that just following the hype, just looking at narrative, I don't think that's a sustainable source of alpha. Just to be sniping the next big narrative that gets big on Twitter. So I think again it comes back to, are you invested in projects that have long-term fundamental values, the token structured in a way that captures that, and doing this in an investment process that is repeatable and relatively sober, not just driven by FOMO.
Yeah, I think it's been really hard for some funds that are very thesis-driven or fundamentals-driven to consistently generate a return over multiple cycles in crypto and to pick the right narrative every single time. There's also some areas that have become more competitive. I think pure market making now is, all of the big trading firms are in this space every day. And so we need to think a lot about where is our niche and our competitive advantage, and where do we think we can price things better than people with much bigger balance sheets than us and a much larger technical team than us can do. So we try to avoid things that are very crowded, and we try to look at things that we think have been neglected by a lot of other funds in the space. For example, lots of market-neutral funds expanded into DeFi, to yield farming, to now staking, restaking type strategies. And I think that's one way you can go to try and find alpha is things that are new and evolving and growing. We've kind of gone the other way and said there's a lot more institutional capital coming into the space since the launch of the ETFs. And so there's a bit of a divide between the traditional market and centralized exchanges. And that's been neglected by a lot of other market makers. So we've tried to focus more on that. So it's always useful to think about what everyone else is doing and see if you can find something new.
And I think this bears the question from an allocator perspective. This was obviously discussed many times over today, is how should an allocator think about their allocation to digital assets if this is their first foray into the asset class? How should they think about allocating to directional or long bias strategies versus market neutral ones?
Yeah, I mean, I think it came up in the prior panel. To me, one of the critical things is to look past Bitcoin. Bitcoin is a great asset. I'm not going to say anything negative about it, but it is one very specific sort of thesis, one specific use case. And if you're interested in crypto, sort of through the promise of blockchain technology, smart programmable money, then you need to be looking at other investments as well. I mean, we're very convicted in the idea of diversification, which, crypto seems to be one of the few markets where people don't actually believe in diversification that much. So I think that applies to having diversified array of, investments in different tokens and different projects, but also in different strategies. I don't think necessarily that you should concentrate in your entire allocation in one long-only, directional strategy, because there are such interesting alpha opportunities in the space as well. So you want to think about the risk profiles of each strategy, how they fit into your portfolio, how much you overall want exposure to crypto, what that means for your overall risk allocation, and then kind of, decompose it into the most attractive strategies, of which there are many. It's not a one solution.
Yeah. On this, I would say Coinbase put out a report last year, which I love, which showed that for any given level of volatility, crypto strategies outperformed their traditional counterparts. So it generated higher returns for roughly the same amount of risk. Worth noting that I think there's a huge survivorship bias problem in crypto. We've seen sort of around 40% of funds blow up after every big liquidation event, 22, 2020, you can go back further. So you need to be careful that you choose funds that have longevity. But I do think there's a lot of exciting opportunities across the whole volatility space, whether you want market neutral, sort of single digit vol and get higher returns than you could get from traditional hedge funds, whether you kind of want momentum type strategies or token picking funds or just sort of long crypto. And I think people should really be looking at all of these, but think about the target level of vol that you want in your portfolio or what vol is missing from your broader portfolio, and then add crypto there. Because the risks are correlated. So while you might see that there's divergence in returns across all of these different strategies, the same kinds of things might wipe them out across the board. So that's whether that's another FTX type blow up or big deleveraging in the space. And so you need to think about the correlated risk as well.
Fantastic. Well, we're almost at time. Thank you very much for your insights on alpha generation in digital assets. Tara, Felix, thank you so much.
Thanks for having us.
Wonderful stuff. That was Alpha